So last time we were discussing some ratios and then we started discussing how to use the PE to predict when to buy a stock and when not to buy a stock. Today we'll start looking at things a little more in detail. So we've done most of these ratios. Market cap, we know what it is, number of shares into the share price of each share, which gives the total value of the company. What is the current price, high, low, what the stock PE we know. What is the book value? Book value is nothing but in the balance sheet. What is the shareholders' equity? Over here in the balance sheet, that is the book value and the book value per share. So the actual share is actually 4,800, but let's say Britannia gets dissolved tomorrow, the company shuts down, then the shareholder will actually get 133 rupees per share. So market value of each share is much higher than the book value. Book value of the share is the share, that is the price of the share calculated basis the balance sheet. Dividend yield is how much dividend the company is giving. So right now, Britannia share price is 4,834. So the company gave a dividend of 1.52% of this. So that is the company gave a dividend of about 7,000. Sorry, by 100. Yeah, so per share, the company gave a dividend of about 73 rupees. So that is dividend yield. Then we have seen ROCE, we have seen ROE. Face value is not that important. We need not worry so much about the face value. It's just a notional thing. What is the share price, the high price? What is the pledge percentage? So we now need to understand what is promoter holding and promoter pledging. So typically, when a company starts, there are people who are known as the promoters. The promoter is actually the owner of the company. So we come here, we have shareholding pattern where we see the promoter. And then we see what the FIIs, DIIs, foreign institutional investors, domestic institutional investors, and then the public. So the promoters are basically the owners of the company. So what percentage of the company do the owners actually own? That is something that we should track very closely. It is very important, or it is usually helpful if the owners own a high percentage of the company. Then it means that the owners have a strong stake if the company does well. And also it's usually very good if we have we have promoters who are focused on say just one company or max, two companies. Usually I prefer promoters who are just focused on one company and that one company is their main income source. So that way all their energy goes into the same company. So for example, we were discussing Lal Pathlabs, right? So if we look at Dr. Lal Pathlabs, for example, the promoters, their primary ownership is their primary business is that of Lal Pathlabs, right? And similarly, if we look at a competitor of Lal Pathlabs, which is Metropolis Healthcare, the promoter of Metropolis is also the primary business of the promoter. Where is Amira Shah? Yeah, okay. So the primary ownership, the primary business of the promoter is this Metropolis Labs. So typically, it is preferable to hold companies where the promoter has a majority or a strong stake in one company, and the company is their primary source of income. This will ensure that the promoter is more focused and only focused on this business. Let's say they have 10 businesses. Then we don't know how much they'll focus on this business. Are they going to really put their life and soul into the business whose shares we hold? Let's say that we hold the shares of the business, but then they say, well, this business doesn't matter. Let's own, we have another 5 businesses and, 3 of those businesses are doing well. Let's forget this business and let's focus on those 3 businesses. So in that way, if promoters do that, then we will not get returns as minority shareholders in companies. So typically it is preferable to hold companies where the promoter has a good stake, right? And this business is the primary business in which the promoter is working. They should not have typically 10 or 20 businesses because their focus might get diluted. Then pledged percentage. So pledged percentage basically means that whenever a promoter, let's say a promoter is taking a loan, and then the promoter has taken a bank loan, and then and then usually when we take any loan, the bank may ask us for some collateral. Say in case you're not able to pay the loan, then what will you, how does the bank recover back its money or its assets? So typically, sometimes promoters may pledge a significant percentage of the stock, right? So that this is what is the pledged percentage. So pledged percentage is something we generally need to be cautious about, because if they have staked a percentage of the company, and let's say they have staked a very huge percentage of the company or a huge percentage of their share, and then tomorrow, let's say the business is not doing well, right? And then the promoters have to basically, the business is not doing well, the promoters are not able to repay their shares because the business is not doing well, the share price crashes, and then they have to repay all the shares to the bank. So that is something that is usually a very dangerous thing. So we need to be careful about this pledge percentage. Why are they actually pledging a percentage of their ownership? Can they not, firstly, why do they need to take a loan? Or to whom have they pledged it? Assuming that they have pledged it to a financial institution, then why do they have to take a loan where they have to pledge their percentage, right? We again come back to the same story where we are looking at debt to profit, debt to equity, and all that. So why are they taking a loan? Now, if they have pledged this percentage, and let's say tomorrow something wrong happens, is this a risk to the organization? So we just need to be a little cautious about this, and that is why this is one of the other metrics. Then we have looked at return on capital employed. We have looked on return on assets, return on equity. These are all metrics we've looked at previously. ROIC, we can just study it on your own. It's somewhat similar to these. Then we have debt to profit, debt to equity, current ratio. These are all debt related ratios. We've seen that in the previous session. And then the next one of the key things we will look at is the sales growth of the organization. So how fast is the sales of the organization growing? So in this particular organization, you can see last 3 years sales growth is a little slow. Profit is profit is actually going down. Then for 5 years, it's a little bit better. Profit is kind of where it was. So typically a good organization is an organization with a very fast sales growth and a very fast profit growth. Those are the kind of organizations that we should typically look to hold. Doesn't mean that we just exclude the others. Let's say we understand the business, then we find out why the share price is why the sales growth is not so high, or why the profit growth is declining. So in the case of a lab, right, whether it's Lal Path Lab or Metropolis Lab, there was COVID. And during COVID, since everyone was getting ill, there were too many tests that were ordered from the company, and therefore the company over here, if you see, it underwent a very significant increase from 760 crore, it became 1,000 crore. But after that, as COVID started easing, and then again here it went up quite high. So during these 3 years, it was a very fast growth from 760 to 1,200. And then as COVID started easing and as things started getting normal, the sales is actually kind of gone down a bit and it's now stabilizing. So that is the reason why Metropolis hasn't grown so far. So typically we should see how is the sales, how much is the sales growth, how much is the profit growth over a 3 year, 5 year, 7 year period. And we should see if it's not growing fast, then is that a temporary thing? Is that a permanent thing? So if this is just a temporary phenomenon and if the share price is really down, then it's a good opportunity to buy that share. But if it is something that is not temporary and it looks like it might be permanent, then we need to be very cautious about getting into a share. So typically we see over here, we have the sales growth 10 years, 5 years, 3 years, and so on. So we need to generally look at this on average and see how a company is doing before we take any decision in terms of whether to purchase that company or not. So this covers all of our main metrics. So today we'll be looking at some conditions as to how do I understand what business to invest in and what business do I stay away from, right? Okay. So this is some of the criteria that I use. Now different people use different criteria. So maybe as a starting point, you can look and understand the logic of the criteria that I'm sharing here. But as time goes on and as your acumen increases, It's important to start following a lot of different people, see how they invest, and then build your own approach and build your own style that suits you. Right. So the first and the most fundamental criteria of any share is, do I understand the business model? Is it a simple business or not? So if you don't understand how a business works, then there is no point in owning the shares. Because you don't know what are the risks to the business, you don't know what the opportunities are. Let's say if you don't understand the business, tomorrow there's a Russia-Ukraine war or some other war, you don't know what the impact of that war might be to the business. If there is again some new like COVID, there is some other influenza that seems to be coming in the news in China. So if there is some COVID-like incident, then what is the impact on the business? If we don't understand the business, we'll not be able to predict what the impact of the business will be based on various events that happen. And therefore, if we cannot predict, and if there is a risk that we might buy a share, the share might crash, and then out of fear, we will just exit because we don't understand when it is a good opportunity to buy and when it is a good opportunity to sell. So it's very, very critical that we understand the business model of companies. So to understand business model of companies, it's always so different. It's always important to start with those companies that you interact with and that you know very well. So for example, someone who's working in a bank might be, or in a financial institution, they might be able to understand the banking sector much better. They may go into NBFCs, they may go into all different banks, and they may understand why a particular bank is down, whether that bank will recover. Someone else, let's say, who's working in an IT or a software company, they may understand the software companies much better. And so they may start investing a bigger percentage of their money in this in the software companies. So depending on your background, it's not the case that all investors or a good investor knows every business thoroughly. Never the case. Usually investors, depending on their area of comfort, have their areas of strength, and they invest basis their areas of strength. So even if we look at someone like Warren Buffett, right, who's supposed to be the greatest investor or one of the greatest investors, we'll see that, for example, in the tech world, right, he has mainly invested only in Apple, but there are so many other tech companies which have done well between, say, 2010 to 2020. So if we just come here and see, let's just see a few tech companies. So for example, you see, there'll be several tech companies which have done extremely well. You can see over here between 2009 to about 2021, that's about 13 years, or rather from here itself, you can see for more than 15 years, Salesforce has given a very strong return, right? From a share price of some 3 to some 290. Or if we look at, for example, again, this company has given good returns for about 10 years. Let's look at Microsoft. Again, Microsoft has given a very good return between, say, this last decade, 2010 to 2020, roughly. We look at Google. Right. Google again has given extremely good returns in this last 10-year period. So if we look at a lot of the tech stocks, a lot of good tech stocks, let's look at Facebook. So Facebook again from 2012 to about 2020, it has also given very good return. From a share price of some 20, it has gone to some 370 odd. So if we look at this, there are a lot of tech stocks, very well-known tech stocks, day-to-day tech stocks that you and I, where, companies whose products you and I have been typically using, whether it's Google or Facebook or Microsoft or and so on. But if you look at Warren Buffett, typically he's not owned almost all these companies. To my knowledge, he's only owned Apple, and yet the person is such a great investor. So it is very important that we pick out our areas of concern. We'll first close this. We'll look at this next time. It is important that we look at our area of competence and we start investing in those areas where we are really, really confident. So one of the things that we can look at is our day-to-day purchases. On a day-to-day basis, for example, we purchase so many different things, right? From clothes to all our household items, household cleaning items, our uh, soaps, shampoos, and so on and so forth. There is stuff like jewelry that we buy. There are slippers that we buy, shoes that we buy. We go in a vehicle, so we'll look at cars. There are so many electrical items. We have fans, lights, bulbs. So we can even look at the companies that are doing these day-to-day things. Women like to buy jewelry. There may be marriages or festivals. There may be those kind of, premium clothing for those occasions. There are companies that focus on that and so on. So even if we look at our day-to-day purchases of items, we will find that there are a lot of good companies that exist. We have houses, we may paint our houses. You can look at the returns that paint companies have given. We buy food products. There are so many there are multiple food companies that have given good returns over the years. So we can start with those kind of businesses. We can start with, say, the businesses where we have more focus. So someone working in software can look at tech companies, for example. Right. Then the next thing we look at is this a fast changing industry? So now let's take the example of a CD drive, or let's take a floppy disk, right? So maybe about 30 years back or 25, 30 years back, it started with floppy disks. There were a lot of floppy disks that were getting used. And then slowly floppy disks were replaced with CD drives. Right, CD, DVDs, and so on. And now even that is gone. So today, if you want to watch a movie, we just go to some Amazon Prime or Netflix, and then it is all streamed online. There is no DVD, there is no CD, there is nothing. So the point is that in a fast changing industry, it is usually, we have to be very, very much on top of that industry. If someone is able to be very, very much on top of that industry and they know what the next trends are, then might as well get into it. But as an investor, if we want to make good money, then and if we are not confident, if the industry is a very fast changing industry, but if we are not confident that we understand this industry inside out, then it is a risky proposition to enter in that industry, because if there is some disruptive force, then we may end up losing our investment, right? So from that perspective, if you want to buy the stock at this point of time, as we start, better to avoid these putting our money in this for now, but we might as well study it. So maybe someone who's working in tech, they might know some fast changing areas where they think a lot of money can be made, right? So might as well study it. If the person is very confident, get into it. But if we are not that confident, this is one principle that we can quietly follow. Okay. Then is this an asset light business with low capex requirement? So to understand this, let's look at Airtel. Okay. So this is the share price of Airtel. We see over here, and let's compare it maybe with another company, a simple FMCG company or something. So you see over here, okay, during this, Airtel first entered the markets during the start of the 2000s. And then within a few years, it gave a very good return, right? Within 5 years, it gave a multifold return. But after that, from 2007 until 2019, okay, this stock has given nothing. Over 12 years, the stock has given nothing. Even now, even if you look at it over the last few years, the company has given a good return seemingly. But let's look at Airtel. Okay. And you see over here, the valuation of Airtel, like market cap to sale, is one more way of valuing a stock, right? What is the market cap? The market capitalization is this much. This is nothing but number of shares into price per share. That total value is this 9.56 lakh crore. And then we have what is the sale of the company in the previous year. The total sale of the company in the previous year. That is this number, right? So when we divide the sale by when we divide the market cap by the sales, it tells us, okay, is the market cap? The market cap is directly proportional to share price because it is price per share into number of shares, right? So this is directly proportional to the share price. So this is telling us this increase in share price that we are seeing. Is it because the sales are increasing a lot? Or is it because of some other reason? As you can see here, the market cap to sale price has actually gone up. So this is again one more indicator of valuation. When a company has a low market cap to sale, it's generally a good time to buy. When a company has a high market cap to sale, we have to generally be very careful. And this may also be because of sentiment. So fundamentally, it doesn't show that Airtel has changed or there has been an explosive strength in its earnings. Right. So let's look at this. If you look at Airtel's profit growth in the last 3 years, it is nothing. It is -2%. Right. Airtel's sales have been steadily kind of going up. You look at 10 years, there's been some sort of a return, 16%. But in the last 3 years, you look at this is -2%. There's been no profit growth at all. But if we look at the share price in the last 3 years, the share price has gone from 700 rupees to 1600 rupees. So to me, there is no fundamental reason why the share price has gone up by 2.5 times. Right. So now why have we looked at Airtel and how is that related to CapEx? So if you look at the mobile business, earlier we were having 2G, 3G, 4G, now we are thinking of 5G. So as consumers, we are experiencing a lot of increase in the speed of and the quality in terms of what we are able to do with a mobile. Airtel as a company or any of these mobile companies, they may be making a lot of profits, yes. But then they have to continuously reinvest that profit to upgrade their infrastructure so that they can support the next generation of technology, whether it is 2G, 3G, then 4G, then 5G, and then whatever comes next. Right. So the cash is getting reinvested in new infrastructure, in new, say, in new items in order to support the next level of technology so that they can just stay relevant in the game. And therefore, as a business owner, the business owner is not making that much of money. And you see the investors have not given much of a they've not the share price has not gone up. The investors don't think this company has been worth much for a long time. They've just said it's kind of pretty much been the same price for 12 years. And even now, there doesn't seem to be any fundamental reason for its increase, at least in the last 3 years. But let's take another company, for example. Any simple company that we look at. Let's just take Britannia. We all know Britannia. We buy bread, we buy cheese, we buy biscuits, we buy whatnot. So let's just take the case of Britannia. So this part, I think maybe the price is very, very low. Maybe if we zoom in, we'll see. But even here, the share price has kind of gone up a bit. But if we look at this company, or let's just take, if we look at Britannia, for example, you see it's steadily going up. And even if we zoom in, it's kind of steadily going up. Or we take another company like Asian Paints, right? And we look at it over a 10-year period. So this is again 2009 up to from 2009 to about 2021. Now there is some correction going on because of the entry of Aditya Birla and so on. But right now you see this is steadily going on. And if you look at the history of Asian Paints over the last 3-4 decades, the company has steadily been compounding. Or you take Pidilite. Now, what is, Fevicol, this company has also been steadily compounding. Now, what is the relationship between, say, something like this and something like this? Now, an asset-light business, when we buy, let's say we buy cheese or we buy biscuit, there is no 2G biscuit, 3G biscuit, 4G biscuit, and so on. Of course, they may come up with some new biscuit designs. They may put some, some chocolate in the biscuit. They may come up with some type of cookies and so on. But there are many things that just remain the same. Bread remains the same, cheese remains the same, paint remains the same, Fevicol remains the same, everything remains the same. The company which has a certain infrastructure, they can keep using that infrastructure for decades. Right? If they built a factory, we know for a fact that the factory that, say, a company like Asian Paints or Pidilite has built will remain relevant for the next 10 years, 20 years, 30 years. But if there is any, say, mobile 3G or 4G, it may not even be relevant for 5 years, right? Within 5 to 10 years, new technologies might come up. And therefore, the companies which don't have to keep investing again and again in their own to build more infrastructure, those companies are giving steady shareholder returns. Whereas a company like Airtel, which has to keep reinvesting its profit, has to build infrastructure and so on, this company has not been giving such a good return for extended periods of time, right? So from that perspective, again, these are all just guidelines. It's not a hard and fast rule. These are just guidelines. It's generally safer to own an asset-light business which has low capex requirement. Capex is capital expenditure. They need to add new factories, new machinery, new towers in the case of mobile and so on. Okay. So any doubts so far in these three criteria? Okay. So let's look at the next criteria. Typically, cyclical businesses. If we enter cyclical businesses, we need to know how to trade. So a cyclical business is a business. Let's take, for example, some sugar company in India. Let's just take some Dhampur sugar or some other sugar. Now, a cyclical company, you can see the stock is cyclical. It goes down, goes up, goes down, goes up, goes up, goes down, goes up, goes down. That's typically a cyclical company, right? Uh, so if we just look at this share, Dhampur Sugar, you see the share price of this company, the profitability is first, it's high. Then it's gone into losses. Then it has again become profitable. Then it's become less profitable. Then it's again become profitable. Then now it's again becoming less profitable. In the future, it'll again become profitable. So the business moves in waves of profits of up and down, up and down. And why does that happen? So let's just take a simple example of, let's just take a hypothetical sugar business, right? So in sugar, it's very easy to manufacture sugar. It's not that complicated. So let's say sugar price is very, very high. Let's just take that part. Sugar price is very, very high. So then a lot of new players will find, okay, now sugar price is very, very high. Let me enter into the sugar business. And then I will also start selling sugar and I will start making a profit. So a lot of new players enter. Okay. As there are a lot of new players enter, the manufacturing goes up. So the amount of sugar that is available basically goes up. Since the sugar is since the quantity goes up, price goes down. Okay. Now, as the price goes down, what happens? A lot of the smaller companies that have entered the sugar business, smaller companies that don't have huge manufacturing capacity and therefore they can't manufacture it at a low price. These kind of smaller players shut shop. They exit the business. They say, no, we are not getting any profit. We don't want to play in this business anymore. Right. So as smaller players shut shop, then the production goes down. And then as the production goes down, what happens? Price goes higher. Now, once the price is very high, again the cycle happens. A lot of new players enter. They'll manufacture more because there is so much sugar available. Price goes down. Again, smaller players shut shop. Production, because now smaller players don't exist. Total production quantity is down, right? And because production quantity is down, price goes higher, and this cycle keeps repeating. And this typically happens for what are known as commodity businesses. Commodity businesses is simple day-to-day business. So, for example, if we look at sugar, or if we look at for example, the dal we are buying, typically we don't, or a lot of households don't look at the exact, for example, which is the brand or from whom are we buying. Even if we go to buy some vegetables or something, we just go in the market. A lot of loose dal, maybe sold and we may just buy that, right? So for commodities, typically, these kind of cyclicity can occur. And whenever these businesses are cyclical, so let's say we buy a business, we say, oh, this sugar company's stock share price has gone up, very good. So let's say we come here and at some point of time we say, oh, the sugar company share price has gone up. Okay. The sugar company's profitability has also increased enormously. Okay. So the financials over the last 3 years look good. Right. I think that now the company has some super secret formula and it will do well in the next 3 to 5 years. Let me buy it now. There are people who think this way and then they buy it when the price is very high. And then after they buy it, the price goes down and for 3 to 5 years, they are stuck with that stock. And they're at 30%, 40%, 50%, 60% loss. And then after a point of time, they get very frustrated. Okay, I've held the stock for 3 years and now I'm at a loss, and then they sell the company. And after that, what happens? The next cycle starts. So they will buy it at the high end of the cycle, right? They buy it at the high end of the cycle, thinking. So let's look at 2018, for example. You can see here, somewhat the profits were somewhat high, right around this time, and then they buy it. During 2018 to 2019, the profit was also quite high. So even quarterly results would have been good. So around this time, they buy it somewhere in 2018, let's say somewhere around here or wherever. And then after they buy it, the stock price kind of comes down. And then they think, okay, we've bought it now. I've bought it in 2000, whatever, 2017, 2018. And now I've held it for almost 3 years. And now the price is less than half of the price at which I bought it for. And then they get very frustrated and then they will sell it. So that is a mistake that a lot of investors make. So they buy it at the peak of the cycle. The peak of the cycle. When is the peak of the cycle? The peak of the cycle is when the price is very high and the production quantity is very low. The production quantity is low, price is high. That is the peak of the cycle. They will buy it in the peak of the cycle, right? As the smaller players are shutting shop and the production quantity keeps going down, the bigger players start making more and more profit because the price keeps getting higher and higher. As the bigger players start making more and more profit, you see here, you will look at the financial results and then you will say, oh, okay, this was at minus 13 crore or minus 78 crore loss, and then its profit is going up, very good. This company is going to be very successful. And then they will buy it typically at the peak. And then once the price is very high, the new players start entering and then the price goes down through this cycle. And then once the price goes down like this, then the stock price also, the price of sugar goes down, the profitability goes down, the profitability is down, the stock price is down, and then the stock price is down. And then at the time when the investor should actually be buying the stock, they will sell the stock. So we have to be very, very careful in cyclical companies. And similarly in commodity business also, it's best not to enter. We should enter businesses which have what is known as a moat. So we'll talk about moat separately, but but think of a moat this way. Let's say you have bought a new house. You have spent, let's say, 1.5 crore to buy a new house, right? And now you want to paint that house. Will you go to some unknown paint shop, paint company that you don't know? We typically don't do that. When we've invested 1.5 crore in that house, then we will go to the best paint company. Even if it costs a few lakhs, I will say, no, I've invested so much in this house, I want really good quality. And then we'll go to the best paint companies, maybe from Asian Paints or Berger Paints or whatever. And that's because all paints are not created equal. There are some companies which are known for superior quality. And we do that, and those are companies that have built a brand, right? They have a brand, uh, they have a lot of recognition, and we should typically try and purchase those kinds of companies, because companies which have built a brand, companies which have increasing sales, increasing profits, etc., they typically do very well. And companies that have brands and that are in a good business will continue to increase their sales and profits over time. Okay. So this is also another key criteria. Now let's look at the next criteria. Has the company been profitable over the past 10 years through good times and bad? Okay. So now it is not entirely necessary that the company has to be profitable. I have also bought companies which become loss making during a down cycle and then they again become profitable in up cycle and then I will sell it in the up cycle. I have also done that. But if we are new to the investing game, then it is always safer to buy companies which are consistently profitable over the past maybe several years. And the reason is that even if we make a mistake, you know, even if we make a mistake, we are not worried that the share will crash, that the share price will crash, the company will shut down, and oh, I will lose all my money. That will not happen if we look at companies that are consistently profitable, right? So we not only look at the profitability, we will also look at the growth in terms of the profits. Have the sales grown? Have the profits grown? And companies which have had good sales growth, good profit growth, and which have a bigger market to be captured or which have the potential to grow over the next, say, 5 years, 10 years, 20 years, those are the kind of companies that are very safe companies to be bought. Okay. Does the company have a stable double-digit operating profit margin? Is there steady growth in the profit margins? So this is something we have discussed in the past that when we were talking about the income statement, we were talking about the operating profit margin and we spoke about how, if a company has a very good operating profit margin. So let's look at CDSL, for example. And you see here operating profit margin is some 50 to 60%. Now let's compare this with this sugar company. This sugar company has an operating margin of between 5. This is actually 0 here. But anyway, on average, let's say it is between 5% to maybe 18%. Right. So even if something goes wrong for this company, say 1 year something goes wrong, there are some unknown negative factors that happen, the company will still have a very high profit margin. Instead of 60, it may become 40. But for this company, if something goes wrong, for example, maybe the profit, it may go into loss. And share price, typically in the long term, the share price follows the profit. If the profits keep increasing, the share price keeps going up. So this is another safety, a way to be safe, because the key thing in the stock market is to ensure that we don't lose money. Okay. Is the profit margin consistent over many years? Now, this is something so it's not necessary that it has to be exact. No company can maintain an exact profit margin depending on the raw material, depending on the price of the raw materials, and depending on different factors. The profit margin may vary a little, but usually it will follow a range. So if we look at any decent company, it will follow a range. Like, let's just take a good company here. So you can see here Asian Paints has varies between 13% to maybe about 23%. So typically, if we look at not this is quarterly, sorry, let's look at annual. So annual, it varies between, say, some 16% to about 22%. So it's just about 6-7% variance. And this depends on things like, for example, the price of raw materials, like oil is one of the key raw material for paints. Right? When oil price goes up, when oil price goes down, then the profit margin kind of changes because they don't pass all the price change to the end customer, because India is a very price sensitive market. So based on these things, the operating profit margin will typically be in a range. But we should ensure that the operating profit margin doesn't undergo some wild cycles. It can't be like minus 50% 1 year and then it goes to 50% the next year. If that is the case, that's not a stable business. In investing, it's at least when we are starting, it's better to be a tortoise than to be the rabbit. And so these are ways to ensure that we are like a tortoise, we are steadily going up. Okay. Has the company been steadily, consistently growing its revenue and earnings at double digits? So company has to keep growing and company has to have the potential to grow further. So can the company become much bigger? Like, let's take an example, right? If we look at, for example, the CD business or the DVDs, CD and DVD were getting manufactured at one point of time. Does the CD business or DVD business have any potential to grow? The answer is no. Right now we have everything is in cloud and everything is via streaming, happens via the internet streaming and so on. So for example, CD and DVD business does not have the potential to grow. But if we look at some other companies, Like for example, right, we are now having data centers. A lot of data centers are slowly coming up in India. Does a data center have a potential to grow? The answer is yes. The reason, what is the reason? There is a lot of UPI transactions, there is a lot of digitization that is happening in India. Even small street vendors have started using UPI, right? So, and there are more people who are having bank accounts, who are getting into banks, who are having a lot of financial trials, financial transactions. There are more people getting having credit cards and so on. So all that data of all the transactions that people have made, what has gone on, the history of all that, everything, for all that to happen, we will need those data centers that will kind of store some of that financially relevant data. So in that way, we can say, okay, where is the trend going? So there is more digitization. In the same way, we can say, for example, that our online sales like Amazon and Flipkart, etc., they have been continuously growing in India, and they will continue to grow in India as the Indian market, as India slowly develops, as the Indian market, there is more of newer, younger generation who is more tech savvy. So in the last 5 years, they've continued to grow, and these factors will continue to play in their favor, and they will continue to grow. So using our common sense, we should, and not just common sense, just studying and understanding things using online resources, we should be able to largely predict which businesses can go up, which businesses can't go up. And if we don't know, let's say we don't know whether a particular business will go up or not, then just stay away from it. Don't take a risk. Okay. And then does the company still have room to grow? Is there a large growing market that the company can capture? So again, we take a simple example. We have taken, for example, the DVDs, right? The DVD, there is no room to grow. But this other example that we took of data center, there is obviously more room to grow. Okay. So I think we'll stop with these 9 today. We'll do the rest of the factors in the next session, right? And then we'll continue. I think we'll take about 2, 3 more sessions to complete this whole set of factors. But once we understand this, we will get some sort of an idea in terms of which business to select, which business not to select, and how to be intelligent about getting into the right companies in terms of buying the right companies.